Hi traders, Teo Nagpan here, founder of Master the Markets, Elite Traders Conference and the Traders Open Day. So today I just want to share with you this topic on the 3 entry rules to boost your trading performance. You see, over the 20,000 traders that we have coached over the time in terms of the conferences and the talks that we've done all over the world, we have found one of the challenges that traders have is that they do enter into a trade, but then they find themselves kind of locked into a trade and then being stopped out. So their entries are not really optimized, or they're not getting the right timing for their entry, as sometimes they tell us when they come into our coaching sessions. They say, Tiru, I need some help with my entry. You see, so this topic over here, the 3 entry rules, can actually help you optimize your entry and overall improve your strategy performance. All right. So this is what we're going to be looking at today in this video. The first one is what we call time frame correlation. Okay, time frame correlation, short form, abbreviation TFC. All right. Okay. Now in TFC, one thing you do have to remember when you're correlating the different time frames is that you got to remember 3 times. Okay, 3 times. Now, some of you may be wondering, Tiru, what do you mean? What do you actually mean by 3 times? Okay, what I mean is that, for example, if you are an intraday trader trading on a shorter time frame, like a 1 hour time frame, then you need to be looking at 3 time frames at least altogether. So the 1 hour, and each of the time frames got to be 3 times the one that you're trading on. 3 times or 4 times. Okay, 3 times or 4 times. Now let me explain with an example. All right, so what we are looking at over here, so if you're trading on a 1 hour time frame over here, let's say 1 hour time frame over here you're trading on, then we are then looking at maybe a 4 hour time frame, 3 to 4 times, right? 1 times 4 is 4 hours, so we're looking at 4 hours over here. And then after that, if you want to 4 times that, approximately that's about a daily time frame. 16 hours is about daily time frame. So over here, daily time frame. So what we're looking at over here is to correlate these time frames before we take the trade. Okay, and we're usually looking about 3 time frames, and each of the time frames 3 times each other. Now let me explain. So for example, let's say you are an end of day trader, and you want to position yourself and enter onto a 4 hour time frame. And then you can then start to look at daily time frame, and then for 3 times 4 times that, that'll be a weekly time frame as well, what you're looking at. Right, now let me explain why this is important. Right, let me explain why this is important. For example, imagine this, right? You would have probably experienced this. So in a 1 hour time frame, it looks something like this, right? And it's going down, and you're thinking, this is looking like a very good short setup where the direction is going further down. You put your entry over here, and let's say you put your stop loss over here, and you're good to go. And let's say your target is something around there. Okay, so in the next hour, the trade then triggers you in and starts to go towards your target. Everything is well and rosy. You're happy, you are in profit, and you're thinking, okay, matter of time, I'll reach my target. Then what happens? The usual thing that happens, you all definitely would have experienced it. Those who have traded, trading at the moment as well, you can see that it will start to then reverse, and where your stop loss is, let's say other people's traders have all trailed stop loss to here as well. Suddenly, the market then reverses and shoots up and takes out all the stops. I'm sure you all have experienced this. Now, why does that happen? It is because what's happening, traders, over here, imagine this is the 1 hour time frame that you're looking at. Now, if you didn't correlate between the other time frames, the 4 hour and the daily time frame, and let's say the 4 hour and the daily time frame are in an uptrend. Let's say the daily time frame is in an uptrend, and the 4 hour is in an uptrend as well. If that was the case, what happens is that daily time frame orders that are inside the daily time frame are being filled by the brokers, and therefore the market is reversing to fill them on a higher time frame. Okay, so this is what is happening, and this is why sometimes you get these sharp reversal moves in the market. So it's very critical that you have to correlate the time frames before you start to take your positions on the 1 hour time frame. In fact, in the last live trading week that we did, where we are doing teaching one strategy called stops to cash. Okay, so what we usually do, we take a contrarian move on a 1 hour time frame where it looks like a perfect short, where all the beginners and even some intermediates will be getting into a short position, but we are looking actually at a contrarian position in terms of the 1 hour time frame. But when you align it to the higher time frames, it's just in line with the trend. That's all we're doing over here. So that's where what we're saying is that as everybody's stops is being taken out, we are actually converting it to cash according to this time frame correlation. Okay, good. I believe that concept is well clear and nice now. Definitely, so do consider that as you're putting into one of those entry rules. The second entry rule that we are looking at is indicators, okay? Indicators. Indicators is quite a critical one that you can actually put into your entry rules also to optimize your strategy performance. Now, in terms of indicators, the usual common ones that we are looking at is, let's say, stochastic, right? And then we are looking at maybe RSI as well. And for example, also you can look at CCI as well, right? You can also look at CCI as well. Now, all these three indicators over here, even though, I mean, they're familiar names, you all have heard about it. I mean, MACD as well, we can add on to it. There's thousands and thousands of indicators, momentum indicators, you know. There's so many of them. But the important thing is, don't just anyhow pick an indicator and just slam it onto the screen, but in fact, ask yourself, what is you looking to achieve? What is the objective of your strategy? And then pick and choose your tools. It's like, for example, like saying, let's say you're driving a car and then it starts to break down. Now, it's not like anyhow you just choose a hammer or you just spanner or anyhow it is. You got to analyze the problem first before choosing the tool that you want to use to repair the mistake in the car or the fault in the car. The same thing over here. As we are looking to optimize our strategy, we got to ask ourselves, what is that tool that's going to be the most efficient? What's going to be the efficient indicator for me to help me optimize my strategy performance and towards what objective as well? And that's how you actually choose the indicator that you want to have on the screens in your strategy. The last one that we are looking at is price action. Okay, price action is what we are looking at. All right, price action. Now, price action is very critical because in fact most of our strategies we actually use price action because it's the most fastest of them all. Okay, some things that the price is not able to tell you, that's when we use indicators, okay, because it involves a lot of calculations and all that kind of stuff. Right, in terms of price actions, know some really powerful bar patterns that gives you an edge in the market, and then using all these three factors together that can give you a very strong edge against all the other 99% traders. Okay, so for example, price action patterns, we can be starting to look like something like this, okay, or something even like this, where the low test bar starts to come up over here and starting to show a reversal pattern, okay, or even things like on a daily time frame where we are looking at something like a downtrend and then starting to reverse. All those kind of critical price action patterns that can give you an edge. Okay, so these three rules that I've just gone through with you right now can be so important to improving your whole strategy and your trading performance. Okay, now do remember, finally, to conclude off, what I just do want you all to remember is that just using them by themselves is not enough, traders, but using them as a cumulative manner strengthens your edge so strongly in the market and also optimizes and maximizes your trading performance for consistent profits. Okay, I believe this has been very useful for you all, and as we always say, till the next time, stay disciplined, follow your trading plan, and keep trading like a master.